Welcome to lesson 2 of our statement of cash flow IS 7. Lesson 2 focuses on the methods that are used in presenting the items in the statement of cash flow. So we have two methods. The first method is the indirect method, and the second method is a method which is called the direct method. So we are going to focus with our first method, which is indirect method. Let us start with the indirect method. So we shall come up with a statement. So we shall say consolidated statement. Let us have a heading. Let us call it my name. We shall call it Ibrahim and Co Ltd. Then we say consolidated statement. Consolidated statement. A statement of cash flows. Ibrahim D Ltd. Consolidated statement of cash flow for the year ended. For the year ended. For the year ended. I can say, let's talk about 31st December, just an example, 2025. This is for explanation purpose. Let us assume our amount is in Kenya shillings. So our currency is in terms of Kenya shillings. Aha. So we start with the cash flow from operating activities. So we start with the first one, cash flows from operating activities. From operating activities. So we start with the profit before tax. Profit before tax. So I just put it in one column. Then you do adjustments for adjustment for. So number one, you can start with the number one, depreciation and amortization. You can have depreciation and amortization. So you ask yourself, what was the effect in the income statement? So for adjustment, you need to ask yourself some questions. For example, number one, what was the effect of depreciation in determining the profit before tax? Now, the effect was the depreciation was deducted. So if it was deducted, we need to add it back. So we add back depreciation and amortization. So we add back depreciation and amortization. We have the investment income. Investment income. So what was the effect? It was added back. So it was added, so we deduct. So it was added, so we deduct. We have the interest expense. Interest expense. Interest expense. The other people call them the finance cost. So if you say the finance cost, it's the same thing. So what was the effect? It was deducted, so we add them back. So it was deducted, so we add them back. We have the foreign exchange loss. Foreign exchange loss. Foreign exchange loss. It was deducted. We add them back. What else can we have? We have the impairment loss. Impairment loss. So impairment loss, we also add it back since it was deducted. We have the gain from sale of an asset. Gain from sale of an asset. So we deduct. So because it was added, we need to deduct. We also need to check for the interest of other institutions. For example, We have the associate profit. Associate profit. That is, we can talk about the joint venture of the joint venture of the joint venture. So it was added, so we deduct. It was added. Now we are supposed to deduct. So investment income, this one can be in form of dividend or whichever form that you want. So we add them. So we get a gross amount. So we get a gross amount. We call it the gross. Can call it the gross. We can call it cash flow. Let us use another pen so that we differentiate the headings. So this one you can call it cash flows. Cash flows before working capital activities. Before our working capital activities. So let me put it in red so that you know that one. So once we have the cash flows before the working capital activities, then now we can check for the changes in working capital. Changes in working capital. Changes in working capital. Changes in working capital. In working capital. So number one, you can have either increase, or you can have decrease in inventory. Now, when you have an increase in inventory, it means we have purchased more in inventory. When you have a decrease in inventory, it means that we have sold our inventory. So when you have an increase, it means it is money out. So we need to deduct. But when you have a decrease, it means it is money in. So we need to add them. So you need to be very, very conservative with that one. We can have increase in receivables, increase or decrease. Increase stroke decrease in receivables. Now, when you have an increase in receivables, it is money out. We have given people a lot of debt, goods on credit. But when we have a decrease, it means those people are paying back the amount that we gave them on credit. So it is money in. So I hope that one is a good explanation. Then you have payables. So you have increase in payables, or you can have decrease in payables. Decrease in payables. So when you have an increase in payables, it is money in. The other one, it is money out. How? So payables, it means when you have an increase in payables, it means we have our suppliers have given us a lot of goods, but we have not paid them. But when you have a decrease, it means we are paying them, so the account is reducing. So when we are paying them, it means the money is moving out. So once we have those items, we can have the total. We call them the gross cash flow from operation. Gross cash flow from operation. Gross cash flows from operation. Gross cash flow from operation. It can be either a negative or a positive figure, depending on the question. You can get a positive or a negative figure. Then once we have that one, we can less tax. Income tax paid and interest paid. So we can less tax paid, and then we can less also interest paid. Once we less them, we can get now the net cash flow from operating activity. Net cash flows from operating activities. So as I said, it can be a positive or a negative figure. It can be a positive or a negative figure. That's number one. Cash flow from operating activities. Let's go to number two. Net cash flow. Cash flow from investing activities. Cash flows from investing activities. Cash flows from investing activities. Investing activities. Cash flow from investing activities. That's number two. So number one was cash flow from operating activities. So number two, we are under cash flows. Cash flows from investing activities. So I'll talk about number one, acquisition of subsidiary or net cash acquired. So acquisition, we can have PPE, acquisition of PPE subsidiary. So let's just call them acquisition of assets. Acquisition of assets. That's money out. So remember that one is money out. So when you acquire something, you pay. So the assets can be you acquire a subsidiary company, you acquire a PPE, an item of a PPE, etc. We can also have, apart from the acquisition, you can have proceeds from sales of assets. Proceeds from sale of assets. It can be the sale of subsidiary or PPE. Either can do. We can have dividend received and interest received. Dividend received. Dividend received. We can also have interest received. All these will form that's the money in. All those will form what we call the cash flow from investing activities. Now we can find the total. So the total, we call them the net cash flow. Net cash flows from not operating, but rather investing activities. It can be a negative or a positive figure. So if you get a negative figure, don't worry. That one is B. This one is, let us call this one A. So we call that one net cash flow from operating activities. We call it A. Net cash flow from investing activities. We call it boy. We call it boy. Then we go to the last one. Cash flow from financing activities. Allow me to divert to the other side. Cash flow from financing activities. That's the third one. Cash flows from financing activities. So we can have the issue of shares. Issue of shares. We can have issue of share premium in share capital. In share premium. We have issue of loan or debenture. Stock debenture. Stock bond. Stock bond. What else can we have? Loan repayment. Can have loan repayment. You can have loan repayment. We can also have recent paid. if they have rental paid. So payment is money out. Then we can get net cash flow from financing activity. Net cash flows from financing activities. So it can be either a positive or a negative figure. So we got this one C. Then you can get net cash and cash equivalent, net cash and cash equivalent. So this one is, how do we obtain this one? Is A plus B plus C. So when you add A plus B plus C, you will get the net cash and cash equivalent. Then we start with the cash and the cash equivalent. The cash equivalent at the beginning. When you add that one, when you take the net cash and cash equivalent and you add the cash and cash equivalent at the beginning, you shall get the cash and cash equivalent at the end. You shall get the cash and cash equivalent at the end. So that is a format for the direct method. So that is a format for the direct method of the cash flow statement. So that is IS7. IS7. So let us see the indirect method. So let us see the direct. Sorry, let us see the direct method. The direct method. Now for direct method, the format is the same. The format is the same for financing and investing activities. That is for direct. The only difference is under the operating activities. So the only difference is under operating activities. So let me share with you. So the rest will be the same. Apart from the cash flow from operating activities. The rest will be the same. So let us have a format, just a small format. And as I have said, the format will be the same. For investing activities and financing activities. So from this point, at that point, it is the same with the direct method. The only difference with the direct method is from this point, cash flow from operation, up to the net cash flow. So let us see how is it different. So let us come up with the format. So I shall say Ibrahim. So we are going to the direct method. So I would say Ibrahim Diko Ltd. Consolidated statement. Statement of cash flows for the year ended 31st December 2025. Yeah. So now in this case, we shall start with cash flow from operating activities. Cash flows from operating activities. Our currency is in Kenya shillings. Kenya shillings. You can put the currency of your home country. I go with the currency in Kenya. So we start with the cash receipts from customers. So cash receipts. Cash receipts from customers. Cash paid to suppliers. Cash paid to suppliers. Cash paid to suppliers. Then I think from that one, you can get the cash generated from operation. So in this case, we shall get the cash generated from operation. Cash generated from operation. Cash generated from operation. From operation. Then you can less tax and you can less also income tax and interest. So the same item. So less tax paid and we also less interest paid. Interest paid. Now, once we less that item, we shall get the net cash flow from operation. So net cash flow from operation activities. So it can be a positive or a negative figure. Now, once we have that one, now you continue. So from that point, we call this one A. This one we call it A. Now, from that point, now you can continue with the rest. So cash flow from investing activities, you put there below it. Once you finish this one, then you go to the next one below it until you reach at the end where we have the cash and the cash equivalent at the end. So the format is the same. Sorry, the format is the same when we are talking about the cash flow from investing activities and the cash flow from financing activities. The only difference is when we talk about the cash flow from financing activities. So for direct method, so for indirect method, we start with the profit before tax, then we do adjustments, then we check the changes in working capital. But for the direct method, when we talk about the cash flow from operating activities, we do not start from the profit before tax. We start with the receipts and the payments. So receipts from the customers, what the customer paid during the year. Then how much did we pay to our suppliers during the year? Then don't forget to raise tax and the interest paid so that we can get the same amount of. So the amount should be the same. So this net cash flow from operating activities and this one net cash flow from operation activities must be the same when we talk about the two methods. It must be the same. Then from this point now you continue with the rest. So you continue with the cash flow from investing activities and cash flows from financing activities. So that one marks the end of our lesson 2 of this class. So when we meet again, we shall do a question from our past paper. To be specific, we shall do question from CASNEB past papers. CASNEB past papers. So that's all about it for today. Thank you for listening to my class. Share with people so that they can also benefit. This is my contact in case you need any clarification, in case you need to comment or give advice in terms of and improvement. This is my number. So that's all about it for today. So in our lesson 3, we shall meet to do a question in our past paper. So for lesson 3, we shall meet to do a question in our past paper. Thank you.